Hello everyone, my name is Anjani Kumar Khetan. I am based out of Bangalore, and in this video we will continue our discussion on BEPS Action Plan 4. And now we will see how India responded to the recommendations given by BEPS Action Plan 4. So as I mentioned or indicated in one of the previous video, that India responded by legislating Section 94B under the Income Tax Act to take care of the recommendations given by BEPS Action Plan 4. So if you not have got a chance to look at my earlier video on BEPS Action Plan 4 and its recommendations, you see at the top I have given the barcode. This contains the playlist of the two videos which explains the recommendations which was given by OECD under the BEPS Action Plan 4, including the case studies. Now we will look at in this video what Section 94B of Income Tax Act 1961 it deals with and what are the key requirements of this particular section. So in line with the recommendations which were made by the OECD under the BEPS Action Plan 4, as I mentioned, Section 94B was legislated and inserted in the Indian Income Tax Act 1961 with effect from financial year 2017-18. Now, the underlying objective of this section remains exactly the same. What we have seen earlier is to restrict the excessive interest deduction which an MNE may be seeking to claim. Okay. So therefore, in line with the recommendation of OECD BEPS Action Plan 4, basically this Section 94B also seeks to restrict the deductibility of interest expense in the hands of the SSE. So if you look at one by one, some of the key requirements under the Section 94B is that this section provides a cap, a maximum ceiling on allowability of the interest deduction. So it provides a cap on the expense which is incurred by way of interest or something similar to interest, which is incurred and paid or payable to the associated enterprise of the entity. And here the expression or the meaning of associated enterprise is the same as it is assigned or given in Section 92A in the context of transfer pricing which we have under the Indian Income Tax Act. So AE as defined and contemplated under Section 92A of Income Tax Act 1961, that's the meaning which you have to assign to AE for the purpose of Section 94B as well. Now, the cap, when we say that there is a cap under 94B, what that cap is basically lower of the following two amounts. So lower of 30% of the EBITDA of the entity concerned and interest paid or payable to the associated enterprises for a particular year is the cap. So the lower of these two amount is the threshold up to which interest can be allowed or can be claimed by a particular entity SSE. So therefore, if you try to relate this particular requirement of Section 94B, it is similar to what we have discussed in the earlier video series. Basically, India has gone for FRR rule, the fixed ratio rule, and not the group ratio rule. So India have adopted the recommendation of fixed ratio rule for the purpose of limiting the interest deduction. Further, if an entity actually pays excess interest beyond this particular threshold, then that will not be tax deductible in the hands of the SSE or the entity. Now, when we say excess interest, this excess interest has a very specific meaning and the formula which is given in subsection 2 of Section 94B. What that excess interest is? So as contemplated under subsection 2 of Section 94B, excess interest simply means lower of these two amounts. Lower of the total interest paid or payable by the SSE to AE or non-AE. So it's a combination of both. The total interest, the first leg of the calculation, entails the total interest expense in excess of 30% of the EBITDA of the SSE borrower. And now when we are looking at this total interest, it not only includes the interest paid or payable to the associated enterprises, but also to independent third parties as well. This is the first leg of the formula for determining the excess interest. And second leg is interest paid or payable only to the associated enterprises of the entity for that year. So basically, lower of these two amounts will be considered as excess interest under subsection 2. Now, I'll explain some of these nuances, with case study in our next video. But the idea of this particular video is to give you a theoretical framework of what Section 94B is all about. And also I will give you at the end of this particular video a flow chart, which one need to apply to make sure that the entity is in compliance with the requirements of 94B. Now, if you recollect, even in the recommendation by BEPS Action Plan 4, OECD has recommended that it may be possible that a particular tax jurisdiction may allow for the carry forward of this excess interest, which is not allowed in the year when the interest was spent in excess of the threshold permitted. So therefore, even under Section 94B, carry forward of disallowed excess interest is permitted. So if suppose there is an excess interest which is disallowed in a particular year, such disallowed excess interest under the Indian law can be carried forward for 8 subsequent assessment years following the assessment year in which disallowance is made. What simply it means is, let us say that you are at this year. Now in this year, if suppose you incurred a total interest expense of 100 and only 80 was allowed to you, that means the balance 20 was something which was disallowed by application of Section 94B. Now with what this carry forward provision allow, that from this year onwards, for next 8 assessment year, you will be allowed to carry forward this 20 rupees and claim as the deduction in subsequent year or years, subject to the thresholds of Section 94B in subsequent years as well. Again, this is something which we will see in our later discussions as well. And of course, the interest deductibility will also be governed by other considerations, not necessarily from the Income Tax Act, but maybe from, for example, ECB regulations by RBI. Obviously, the interest deduction will continue to be governed by other regulatory provisions as well. Likewise, business purpose test for the borrowing is something which will also be important to see that this interest deduction meets that business purpose test. And if you are making payment to the related parties, of course, the payment should be at arm's length. These are the other ancillary considerations which should also be looked at apart from what Section 94B says. Now moving forward, let us see what are the other requirements in Section 94B is. Now, when it comes to applicability, to whom does this section apply? So if you look at subsection 1 of Section 94B, this Section 94B applies, first of all, to an Indian company where that Indian company is a borrower and that borrower Indian company pays interest in respect of any form of debt which it has taken and from a non-resident associated enterprise. So for example, if ICO is an Indian company, it has its parent sitting in, let us say, a country outside India, and if this parent gives ICO some loan on which interest payment is being made, then this Indian company would be governed, ICO in my example, would be governed by the requirements of Section 94(1) to 94(b), because this section applies to an Indian company who is a borrower and pays interest to an overseas associated enterprise. Then it also applies to a permanent establishment of a foreign company in India. So, for example, if you have FCO as a foreign company, which is outside India, and then this FCO has its permanent establishment in India, let us say, so in this case, if the interest is being paid by this PE of the foreign AE to the associated enterprises, then also this Section 94(b) applies to the PE which is situated in India. Now, when we say debt, if you see here it says the interest would be payable on any form of debt. Now, subsection 5 of Section 94(b) has given a very comprehensive and broad definition of what debt is. For the purpose of Section 94(b), the clarification given in subsection 5 is that debt for this purpose means any loan, any financial instrument, financial lease, any financial derivative, or any other arrangement which gives rise to payout of interest, discount, or other similar financial charge which is otherwise deductible in the computation of business income under the head PGBP. Now, that is the definition of debt as has been given, is a very broad definition given in subsection 5 of Section 94(b). So this is what, if you look at the summarized position of what the applicability is. Also, you should not forget that this subsection 1 has also given an additional requirement wherein it says that Section 94(b) will also apply in this case when you have the debt. So it says the debt is deemed to have been issued by an associate enterprises if the AE, which is located outside of India, situated outside India, that AE, the foreign AE, provides a guarantee. That guarantee could be an explicit guarantee or an implicit guarantee. So this foreign AE gives a guarantee to a non-AE lender, let's say a bank, which in turn lends the money to an Indian AE. Or rather than giving guarantee, let us say the foreign AE deposits a corresponding and matching amount of funds with such lender. Let us see this on the right hand side. Let us explain what this provision in subsection 1 is all about. So let's continue a scenario where you are ICO, an Indian company. It has a parent situated outside India. Now, one option is that the direct loan is given by the parent to the ICO, which we have seen anyway is covered in the first leg of the requirement of subsection 1. But then what this paragraph tells you is on the right hand side. What this tells you is given here. So let us say this is a non-AE, not related party. This bank, let's say a private bank, gives loan to ICO. They give the loan to ICO. And there are two things. Either this loan, which is given to Indian AE, is backed by either a guarantee which is given by the parent or any other foreign AE to this banker, or this foreign AE, in this case the parent, provides a matching or a corresponding amount of funds. So for example, if 10 crore is the amount of loan given by this non-AE to the ICO, a corresponding 10 crore amount is either the guarantee given by the AE or the parent in this case to the third party banker. Either you give 10 crore of the guarantee or you deposit 10 crore of money with this non-AE, and in turn that non-AE banker provides loan to the extent of 10 crore to the Indian company. If that happens, here in this scenario, if any of these things happen, subsection 1 of section 94(b) says that such debt though it is being issued by a non-AE, will still be reckoned. It will still be reckoned as the debt which have been deemed to be issued by the foreign AE. So even if this entity, third party, has given the debt to the or the loan to the ICO, but in situations like this, it will be deemed that the loan has effectively been given by the parent, and therefore the requirements of Section 94B will also get triggered in these cases. That means interest deductibility will get triggered, even deductibility or the limitations thereon will also get triggered even in these circumstances. That's the way you have to look at the requirement of Section 94B. One more clarification is, as I said, and this particular transaction, with the non-AE will be deemed to be a transaction with the AE. Now, one more clarification has been given in Section 94B, which is listed below. If you see here, what it says, Section 94B does not, however, apply to an Indian company or a PE of a foreign company which is engaged in either the banking business or the insurance business. So therefore, the limitation of interest will not be applicable for such companies who are working in the banking sector or insurance sector. This is again in subsection 3. This has been clarified by Section 94B. That's how you have to look at it. Now, one more thing is that we have seen even in the BEPS Action Plan 4, the recommendation was that there can be a possibility of legislating a minimum threshold, the de minimis threshold, so that low risk companies are eliminated from the purview of applying this interest limitation rule. Now, India under Section 94B have also introduced this de minimis threshold. What it says, so accordingly, Section 94B has a monetary threshold of up to 1 crore. So it says, provisions of Section 94B is attracted if the expense relating to interest or of an amount of similar nature exceeds 1 crore rupees. So therefore, up to less than 1 crore rupees of interest expense, the Section 94B doesn't apply. So this is the de minimis threshold which has been given under the Indian Income Tax Act 1961. What we will do in the next slide, we will just summarize what we just discussed by way of a flow chart so that you understand what are the key requirements of Section 94B. And then let's see here. So how does the Section 94B works? Ask these questions. Whether the borrower is an Indian company or a PE of a foreign company. If the answer to this question is no, obviously, then this section doesn't apply, because we have seen the applicability of Section 94B in the last slide. It does apply to an Indian company or a permanent establishment of a foreign company. So if the borrower is neither of these two, then in that case, Section 94B doesn't apply. But if the answer to the first question is yes, that yes, the borrower is either an Indian company or a PE of a foreign company, ask this second question. Whether that borrower is a bank or an insurance company. Because we have seen in the last slide, there is an exception carved out to them under subsection 3. Under subsection 3 of Section 94B, the requirements of this section doesn't apply to a bank or an insurance company. So if the answer to this second question is yes, the borrower is a bank or an insurance company, then again, Section 94B doesn't apply. But if answer to this question is no, it is not a bank or an insurance company, then you ask this third question. Okay, whether the interest paid or payable to the non-resident AE, whether it exceeds the de minimis threshold of 1 crore or more. If it does, then the section applies. If it is not, Section 94B doesn't apply. So if the actual interest does not exceed the threshold of 1 crore, then again 94B doesn't apply. But if it does, then you apply the requirement of Section 94B, and therefore, if there is any excess interest which you are paying, then as we have seen, Section 94B says if you are paying such excess interest, that excess interest defined here is not allowable as deduction under PGBP. That means excess interest, we have already seen excess interest as defined in section 94B in subsection 2. It says excess interest is lower of the interest paid or payable to both AE and non-AE together in excess of 30% of EBITDA. So for example, if your EBITDA is 100, 30% of EBITDA is 30, and if you are paying the interest, let us say 50 to both AE and non-AE, or the interest payable out of this as let's say 20 is to non-AE and 30 is to the AE, right? So the threshold which you have to apply for calculating the excess interest is the 50 which is being paid collectively to AE and non-AE, and the 30 which is paid to the A's for the particular year. And I'll explain this in the next video when we go for the lot of case studies. There I'll explain how the actual calculations work. But that's how the edifice of the entire section 94B is, that if you have the scenario like this, you have to ask these questions. Answer to this question will give an answer whether 94B applies or not. And if it does apply, you have to see whether excess interest is being paid as defined here. If it does, then interest deductibility limitation will get triggered. And if any part of the interest paid or payable has been disallowed by operation of section 94B, we have seen that carry forward is allowed under subsection 4 of the section. It says it can be carried forward up to 8 assessment year following the assessment year in which the disallowance is made. So I will illustrate the requirement of this particular section again in the next video, where we will see 3-4 case studies and we'll take up each case by case what is allowed, what is disallowed in the specific fact pattern, so that you have a clear understanding of these theoretical framework which is given under section 94B, how you practically apply it in real life situations. So this is exactly what I wanted to cover for this particular video. Here is my YouTube link, and this is the link for my LinkedIn channel or LinkedIn profile. Please feel free to connect with me. I would recommend and perhaps request as well to subscribe to my channel and support the channel in whichever way you can, in terms of subscribing, commenting, sharing to people whom you know of and who may be interested in this kind of a topic. Okay. Thank you very much for this particular video, and I'll see you in the next video. Take care. Bye till then. Thank you.